So I think one of the bigger themes that we've seen is a push to real-time risk and margining monitoring. As capital is becoming scarcer and capital is becoming more expensive, firms want to make sure that they're using their capital more efficiently. So they want to make sure that when they put on a trade that they're not going to have an unexpected margin call at the end of the day. They want to make sure that as they put on trades throughout the day that they're not going to be pushing their capital beyond its limits. So what that really comes down to is an ability to monitor in real time their margin requirements from the clearing perspective. So I think from the asset manager side of things, or from the buy side, there's certainly a lot of catch up to do. Real time risk is not ubiquitous. It's getting more popular. It's getting to be something that more people have, but it's not something that everybody has in their toolkit. So being able to monitor risk in real time, particularly in the options world, right, where the risk is not particularly clear cut. But then from the margining perspective, most people have viewed margining as a back office type of operation. It's not a sexy thing. It's not very exciting to anybody. But now, as margin becomes more of a front office issue because of the capital usage and the efficiencies that the traders want to maintain, as we see more events, take events like Brexit, the election, right? Pretty recent events that demonstrated that if you're not on top of your risk in a real-time fashion, things can swing completely one way or the other in a very, very short period of time. So yes, it's very difficult to be a specialist in all of these things. So meaning, if you want to be a hedge fund and focus on your trading and your different strategies, right? That's one thing you're going to specialize in. But then to go off and say, well, I'll also specialize in big data, or I'll also specialize in high-speed networks, or I'll also specialize in all the technology things that go along with markets these days. It's just getting harder and harder. If you want to process the opera feed, it's 300 or 400 gigabytes of data a day, and millions of messages a second flowing through the opera feed. So, compare that to 10 years ago, it was probably an order of magnitude less, maybe more, even smaller than that. So it was easier for firms to sure, we'll manage the opera feed ourselves, not a big deal. Now it becomes a big data problem, and that's just a lot of specialization that no one can really afford now. So these firms are turning toward third parties who are specialists in these areas, and that's something that we take advantage of as a business. We offer that kind of specialization. We're deeply involved with the Options Clearing Corp on their new Timbs initiative. So that's another big focus for us this year, is to help the industry get that new Timbs methodology nailed down and through the regulatory process. Little background, the Options Clearing Corp, the OCC, is working with the industry to refresh the Timbs margining methodology. So Timbs is somewhere between 20 and 30 years old, depends on how you want to measure it. Anecdotally, we heard from someone telling this story that I guess Timbs was officially launched about 20 years ago, but it was 10 years in the SEC and other regulators getting approval. So it's an old methodology. Yeah. So on the technology front, the things that we do see continuing is enormous amount of data coming out of the markets, right? Opera continues to expand its message rates and number of quotes and the amount of data that it pushes out, and that I think is going to be a big technological hurdle for people, is just the increasing amount of data that people have to deal with. It's a big data problem from a size perspective. It's also a big data problem from a frequency perspective. That data just comes at you like a fire hose. It's millions and millions of messages a second. So that's a big issue. Fortunately, the technology is keeping up in terms of storage is getting cheaper, cores are getting cheaper. The GPU, graphics processing unit, which is a tool that we've been using for 10 years now, that's actually coming into the mainstream, and some of the you probably hear about NVIDIA and companies like that involved through artificial intelligence and deep learning and things of that nature. That's starting to, finally, get a foothold within the financial industry as well, which is a good thing for everybody. So I think the technology is keeping up with the markets, but it's not going to let up anytime soon. Markets are going to continue to hit us with a lot of data, and it's just going to get bigger and faster. So.